Welcome to the deep dive. We sift through the documents so you don't have to. Today we're looking at Marsh McLennan MMC, the huge global firm dealing in risk, strategy, and people. They've just dropped their Q3 and 9-month results for 2025, but there's more. A really big strategic change is coming, one that's set to completely reshape how they look and operate. You shared the earnings release and these strategy announcements with us. Our job today, basically to break down the key financials, figure out how healthy MMC is right now, and maybe more importantly, decode this massive transformation they're planning. We want to get to the why behind it all, so let's start with the money side. The Q3 2025 numbers look pretty solid, actually. Seems like a healthy, stable operation. Consolidated revenue, it grew 11% using GAAP accounting, hitting $6.4 billion, and adjusted operating income, that jumped 13%, which pushed their adjusted earnings per share, the EPS, up 11% to $1.85. So decent numbers overall.
Yeah, those GAAP figures, they definitely catch the eye. 11% growth sounds fantastic. But, with a global company like this always buying other firms, those GAAP numbers can sometimes, inflate the picture a bit. To really get a feel for the core engine's performance, like the organic power, we need to look at the gap between that 11% GAAP growth and their underlying revenue growth, which was 4% for the quarter. Okay, 4%. So that's what the business generated itself without currency effects or the boost from companies they bought. Why is that underlying figure so critical for a firm like MMC?
Because that 4% is like the sustainable pulse of the company. It's the revenue from their existing clients, existing services, once you filter out the FX noise and the bump from buying or selling businesses. For Marsh McLennan, especially after big deals like the McGriff acquisition, that 11% JGAAP gap tells you they probably spent their acquisition money effectively, but the 4% underlying, that tells you the core day-to-day business is stable and churning out consistent results. And if you look at the full 9 months up to September 30th, 2025, you see that same stability. Consolidated revenue hit $20.4 billion again, up 11% gap, but holding steady at that 4% underlying growth rate. And the adjusted diluted EPS for those 9 months, up 9% to $7.63.
Right, so steady growth on the top line.
Mm-hmm.
And it looks like they're getting more efficient, too. Adjusted operating income up 13% in Q3, 11% for the year so far.
Mm-hmm.
That suggests they aren't just bringing in more money, but they're also managing costs better.
Yeah, exactly. They're showing real operational leverage there. The adjusted operating income margin actually ticked up in Q3. It hit 22.7%, which is 30 basis points higher than the 22.4% they had last year. Now, the interesting question that raises is that margin improvement just because of the scale from the new acquisitions? Or is it because they were already tightening their belts before this huge strategic overhaul they just announced?
That's a really good point, because if they were already getting more efficient, why launch such a massive radical transformation now?
Yeah.
That slight margin bump almost sets the stage for asking why the big shakeup.
I think they believe they can be significantly more efficient and faster, and importantly, more unified for their clients. That's the core idea here, unification. This is the really big news. The company is officially rebranding. They're going to be known simply as Marsh starting January 2026. They're dropping the McLennan name completely, and even their stock ticker is changing on the NYSE from MMC to MRSH, also in January 26.
Wow, dropping McLennan. That's been part of their identity for, decades? That's a huge cultural shift.
Yeah.
But it goes deeper than just the main company name, right? What about the big operating businesses like Guy Carpenter, Mercer, Oliver Wyman?
Right. Starting in 2027, after a transition period, those 4 core businesses, Marsh itself, Guy Carpenter, Mercer, and Oliver Wyman, they'll all start using that single Marsh brand too. It's clearly a very deliberate, multi-year strategy. The goal seems to be presenting one unified face to the world, signaling that when you hire them, you get the whole company's expertise, not just one division. But like you said, it's not just putting a new logo on things. There's a structural change driving this integration and efficiency push. They're creating a completely new unit called Business and Client Services, or BCS.
Okay, BCS. So what's this unit actually supposed to do day to day?
Think of BCS as the central engine for future capabilities. It's designed to, speed up client impact and boost internal efficiency. How? By centralizing and managing all the key investments in things like operational excellence, data, AI, and analytics. If you want to really leverage AI across consulting, risk, reinsurance, you can't have 4 separate units building their own tech and data systems in isolation. BCS is meant to fix that.
So BCS centralizes the tech, the data, the AI, and the sort of catalyst forcing these changes and aiming for savings is this Thrive program.
Exactly right. Thrive is the label for their 3-year restructuring plan, which they actually kicked off this quarter, Q3. It does involve a significant upfront cost, though. They're targeting around $500 million in one-time expenses. That's mostly for things like severance packages, major tech upgrades, and probably hiring outside consultants to help manage the whole transition.
$500 million just to restructure. That is a serious investment. What's the expected payoff they're banking on?
The potential return is huge. They're projecting annualized savings of roughly $400 million.
$400 million. Every year. That seems incredibly ambitious, especially for a professional services firm where, your main assets are people. If those savings come mainly from streamlining operations and maybe cutting redundant roles, how confident can we be they'll hit that number without hurting the specialized expertise these different brands have built up?
That's the absolute crux of the strategy, isn't it? Hitting that $400 million means streamlining tech and processes, yes, but also finding efficiencies with people. And that inherently carries risk. You might slow growth or lose key talent if it's not handled carefully. CEO John Doyle seems to be betting that the new centralized capabilities from BCS, particularly around data and AI, will make their existing experts much more productive. So they get the savings without sacrificing the quality of client work. It's definitely a high-stakes gamble on successful tech integration.
Okay, let's shift focus a bit. Where is the growth actually coming from right now? What gives them the confidence to undertake this massive overhaul?
We need to look at how the different segments are performing. Good idea. Let's start with Risk and Insurance Services, RIS. That segment brought in $3.9 billion in Q3 revenue. That's a 13% GAAP growth, but on that core underlying basis we talked about, it was 3%. Within RIS, the main Marsh brokerage business showed 4% underlying growth globally. But the real story there, interestingly, is international.
International. So where exactly was Marsh seeing the most strength?
Their international operations grew 5% underlying, which significantly outpaced the U.S. and Canada. That region was solid, but only grew 3%. Asia-Pacific was leading the charge globally at 6% growth, with EMEA close behind at 5%. So it really shows that navigating those complex global markets is a major strength and growth driver for their core insurance broking business right now.
Makes sense. And Guy Carpenter, their reinsurance arm, how did they do?
Guy Carpenter was remarkably steady, posted strong underlying revenue growth of 5% again in Q3. That's consistent with how they've performed all year. Reinsurance seems to be a very stable, solid performer for them, almost regardless of what's happening globally.
All right, now let's look at the consulting segment. That brought in $2.5 billion in Q3 revenue, up 5% underlying. And here, you mentioned, we see a really interesting split in performance between their two big consulting names.
Absolutely. The standout performer really across the entire company in terms of organic growth was the Oliver Wyman Group. That's their management consulting division. They were up a very strong 8% underlying in Q3. For a high-end strategy firm, that's pretty rapid growth.
8% for Oliver Wyman.
Yeah.
What does that tell you about the current business climate? Are companies spending on big strategic advice?
I think it suggests that businesses are definitely willing to pay premium rates for that kind of transformative strategic advice right now. The kind of advice you need for M&A, major restructuring, navigating big economic shifts. When things feel uncertain or volatile, companies often need that top-tier strategic guidance more than ever. And it looks like Oliver Wyman is capturing that demand effectively.
Okay, contrast that with Mercer, their big human capital consulting business. You said they grew a more modest 3% underlying. How does Mercer break down internally to explain that difference?
Yeah, Mercer's performance is more of a mixed picture. The bright spot was definitely health revenue. That was up 6% underlying, pretty much everywhere globally. That seems driven by ongoing needs around complex employee benefits, maybe inflation impacts too. Consistent demand there. Wealth revenue was also stable, up 3% underlying. That was helped by positive net flows into their investment management side. The area that's really holding Mercer's overall growth back is career revenue. That was actually flat in Q3, and it's down 2% for the year so far.
Flat career revenue. That's things like organizational design, pay studies, big talent strategy projects, right? Does that suggest that while CEOs are hiring Oliver Wyman for the next big acquisition strategy, they're maybe pausing expensive long-term projects about reshaping their own workforce?
That's exactly what it looks like. Businesses seem cautious about that kind of large discretionary spending on HR structure and design projects, especially in the US and Canada. They're handling immediate workforce issues, maybe focusing spend on essential benefits, that's the health growth, but postponing the really big, complex HR transformation initiatives for now.
Let's pivot slightly to capital allocation. How are they funding growth in this restructuring? They're still buying up companies pretty aggressively, aren't they?
Oh, very much so. The pace is quite high. They've done 12 acquisitions so far this year. 5 of those were just in Q3, costing about $189 million. And the focus seems to be on building out that core insurance business. 8 of the 12 deals were in the RIS segment. And it's important to remember that big McGriff acquisition they did earlier, that's definitely a significant factor contributing to these strong 2025 GAAP results.
And what about returning capital to shareholders? Still buying back stock?
Yep, that remains a clear priority. They bought back about 1.9 million shares for $400 million just in Q3. That brings the total for the year up to $1.0 billion in share repurchases. Consistently buying back stock like that usually signals management feels pretty confident about the company's financial health going forward.
Okay, now for some of the pressures or headwinds, we saw a big jump in interest expense mentioned.
Yes, that was noticeable. Interest expense shot up by $83 million in Q3 alone, and it's up $256 million for the year to date. That increase is, well, almost entirely linked to the debt they took on to pay for those big acquisitions, including McGriff. It's the cost of funding that growth strategy.
Right. But the materials also mentioned something slightly counterintuitive, a decrease in fiduciary interest income. Given where interest rates have been generally, how does that work?
Yeah, that's a subtle but important point. Fiduciary interest income is what they earn on client funds they hold temporarily, like premiums before they pay the insurers. That income actually went down because the average interest rate they earned on the specific types of short-term, safe investments they're allowed to use for those funds was lower. So it highlights a bit of volatility in the short-term cash markets they operate in, which contrasts sharply with the higher rates they're paying on their long-term debt for acquisitions.
Interesting nuance. Okay. Beyond finance, we have to touch on the legal risks, especially that ongoing Greensill situation. Can you give us some context around that massive $5 billion claim figure that was mentioned?
Yeah, that's critical context for understanding the risks they manage. The Greensill litigation stems from Marsh's role as the insurance broker for policies that backed Greensill's supply chain finance business. When Greensill collapsed spectacularly, those insurance policies came under intense scrutiny, and that exposed Marsh to potentially huge liabilities. The latest twist is that Credit Suisse, acting for investors who lost money, has added Marsh Ltd directly into the Australian legal proceedings. And they are claiming losses totaling around $5 billion plus interest and costs. Now, Marsh did settle a separate large claim with another party, White Oak, back in May, and importantly, that was covered by their E&O insurance. But the sheer size and complexity of this main Greensill omnibus litigation just underscores the massive financial risks inherent in their business. Mediation is apparently scheduled for early 2026.
$5 billion is a staggering number. And finally, just looking at broader operational risks, what kind of macro headwinds did the company specifically call out in their report?
They flagged the usual suspects, what they feel particularly relevant now. Things like the complex and tense geopolitical situation, mentioning multiple global conflicts. Also, the persistent threat of major cyber attacks and ransomware, always a risk for a data-heavy firm like them. And interestingly, they specifically mentioned the operational and financial burden of complying with this new wave of regulations around AI, plus ongoing cybersecurity mandates and data privacy rules across all the different countries they operate in.
Okay, so let's try to wrap this up. Marsh McLennan seems like a fundamentally stable business right now, delivering that 4% underlying growth. That growth is being driven particularly by their international insurance arm and the very strong performance from Oliver Wyman and strategic consulting. At the same time, they're spending significantly on acquisitions to grow and launching this incredibly ambitious full-scale transformation, unifying the entire company under this single Marsh brand, creating the central BCS unit, and aiming for that $400 billion a year in savings via the Thrive program, heavily leaning on technology and AI.
Exactly. The whole strategy seems centered on streamlining everything, processes, data, AI capabilities under this new BCS structure to really drive efficiency gains. And that brings us right back to that final provocative thought for you to chew on. This whole unification plan means potentially trading away the distinct decades-old brand identities and reputations of firms like Mercer and Oliver Wyman. They're swapping that specialized brand power for centralized operational muscle and, presumably, better cross-selling opportunities under the single Marsh banner. So the big question is, Does this bold move risk diluting the very specialized cachet that allowed, say, Oliver Wyman to achieve that impressive 8% growth? Is the trade-off worth it? Or is the power of this new centralized BCS infrastructure truly going to be enough to make the name Marsh synonymous with top-tier expertise across all areas, risk, people, strategy, globally? Getting that balance right between brand identity and operational efficiency, that's really going to determine if they reach the next level of growth or if they just end up being a slightly leaner version of their current selves. It's definitely one to watch.